Good morning, everyone. Welcome to our 13th annual Investment Manager webinar. I want to let everyone know right out of the gate that this call will be recorded and it will be made available to those registrants who signed up for this call. So we're thrilled to see you all today. Thank you so much for joining us. Our relationships with you, our partners in the asset management community, are extremely important to us. And our goal with this webinar is really to ensure that we are transparent with you about our goals and objectives, what our clients are looking at, how we underwrite managers, and who are the people on the NEPC team that you should be reaching out to. So we'll start with an NEPC update and a bit of color on allocator trends and the investment team's composition. I'll tell you about who's on the investment team at NEPC. Then Rosann Halleran is going to describe NEPC's research process. We'll highlight some manager search activity that we've seen in the past year. Nina Petkova will do that. She'll also talk about our approach to fees. And then Lily Fayerweather will close us out with an update on our work as it relates to diversity, equity, and inclusion. So I'm thrilled to be joined today by some of my colleagues on the investment team. Going from left to right, we have Rosann Halleran, who's a senior investment director on our public equity team, our marketable equity team. We have Nina Petkova, who's also a senior investment director on our marketable equity team. And we have Lily Fayerweather, who is our investment specialist within DEI, ESG, and many other areas. And I'm Sarah Samuels. I'm a partner at NEPC, and I oversee our investment manager research team across all asset classes, from public markets to hedge funds to private markets. All right, so first I'm going to give a business update on NEPC. We remain independently owned by our 50 partners, and this is so important. This independence allows us to put our clients' interest first and to avoid conflicts of interest. So 100% of our revenue comes from our advisory and our discretionary investment services. It also allows us to be nimble in how we approach the very rapidly changing investment landscape today. We have over 350 employees across 7 regional offices in the United States, with many employees working remotely from their homes in other areas of the country, which we've been doing since long before COVID. I'm also pleased to announce that we'll be opening our first non-US office. We're going to be opening an office in London in the fall of this year. And that effort is going to be led by Larissa Davey, who's a senior investment officer, senior investment director here at NEPC, and a longtime NEPC employee. So we already have a global presence with our investment managers, with our investment portfolios. We go overseas all the time to meet with managers, and we frequently travel to these places, but this London office will really help us be in a central location for many of those non-US meetings. And we look forward to seeing and meeting with many of you when we're there. We work across 7 client types. So we do have a very diversified client base. And that ranges from private wealth to endowments and foundations, to healthcare institutions, to corporate defined benefit and defined contribution, to Taft-Hartley, to insurance. And our client-facing consultant teams are organized according to client type, whereas our investment research team is organized according to beta, according to the investment type. We have $1.4 trillion in assets under advisement and management as of January of 2023, and we have just over 400 clients. So one of our goals at NEPC is to be big, but to feel small. And what we mean by that is that we bring our vast resources to bear with that $1.4 trillion and with that really diversified and broad client base. We bring those resources to bear both to our managers and to our clients, but we really seek to offer each and every client an experience that they are very important to us, and that we give extremely customized service to our clients. So we have a very low client to consultant ratio relative to the marketplace. All right, so each year Greenwich Associates conducts a survey of institutional investors, and it has some really great and interesting information. And I just want to highlight some of these key themes for you that we're seeing among investors. Many of you are probably also seeing this as well from your seats, but I think it's important that we communicate to you what investors out there who are your potential or current clients are thinking about before we get into NEPC's team and NEPC's approach. So this page shows a number of challenges that are front of mind for institutional investors at any given time. And this page really shows that asset allocation, market volatility, rate of return and funding issues, inflation, and risk management are really the most important issues at the front of people's minds today. There are a couple pretty big shifts from last year, which I'll highlight. One is the decline in concern with rate of return and funding issues. You'll see we had a decline from 46% of investors really worried about their future looking returns, 46% down to 29% today. And really that's because of the market reset a year ago and the more favorable return prospects looking forward relative to where we were a couple of years ago. And the other big change is inflation. So 2 years ago, only 4% of clients were really worried about inflation. We had such a long time with extremely low inflation that it was really hard to imagine it would ever rear its head. But 2 years ago, during this exact call, we noted that inflation was likely to become more of a concern going forward. And sure enough, we saw a 7-fold increase in clients reporting that inflation is proving to be a problem for them. With the reset in valuations in 2022, as I mentioned, forward expected returns are more within reach, but even still, for many clients, it's going to be difficult to achieve their return targets. So CPI plus 5% for an endowment or a 6.5% nominal rate of return for a public pension fund. It's going to be difficult to achieve that with beta alone. And so this is the solution for many clients is picking excellent active managers. And that's where many of you come in. We've also seen a pretty big shift to private markets in recent years, and that's not really reflected on this page, but I think it's an important trend to highlight. So many clients have increased their exposure to private markets in search of a strong return that can help them get to their return requirements. And many clients are now overweight private markets relative to targets due to the denominator effect with public markets declining last year. We do expect this to correct in time. We've seen it happen before, and clients are being judicious in the private market commitments that they're making this year. We're also seeing GPs slowing down their fundraising timelines. Clients are also really focused on liquidity sources for their portfolios. And we're talking about liquidity for a number of reasons, but primarily we're talking about those high fixed liabilities, which are the capital commitments that were made and that are not yet called for their private market portfolios. These commitments were made when the value of the overall investment pool was higher, and now they're an increasingly large burden for clients to be able to make good on. So to meet their spending needs, meet capital call requirements, and if they're lucky, take advantage of some opportunistic investments. If there are some fat pitches out there, which we think there might be, we're really advising clients to be careful about how they're managing liquidity. And we're talking really liquid stuff, cash, treasuries, and other solutions there. So please keep that in mind. Here we have some expected asset allocation shifts as reported by the clients who are surveyed. And I think there are a couple of themes worth highlighting here. One is that US equities are more likely to have lower allocations in the next 3 years. And this is really, I think, due to the lower risk premium that we're seeing coming from equities relative to bonds. Interestingly, though, active management is making a big comeback relative to other years, where more investors are increasing their active exposure to even US equities. We are optimistic at NEPC about the potential for alpha going forward. With cross-sectional variation and volatility coming back, we believe it should be favorable for active managers. The other theme is, we've seen clients reevaluate the role of hedge funds in their portfolios over the last several years. They've been reducing hedge fund allocations for the most part in favor of increasing private markets exposure. This last year, though, we are seeing an uptick both in the work we're doing with clients as well as the data on this page, We're seeing an uptick in hedge fund interest, along with continued interest in growing private market allocations. And finally, ESG and DEI have become increasingly important to allocators, to investors, to clients across the globe. And I'm going to leave it to Lily Fayerweather to go deeper on this and talk about these trends in more detail in a moment. All right, so shifting gears to NEPC's team. These next few pages show our NEPC investment research team according to a few different cuts. And here we show our leadership team within NEPC's investment team. So, you know, the right half of the page shows our investment manager research team, and that's the team you're hearing from on today's call. You might know we organize our teams within manager research according to the exposures. So we have our marketable teams, and that's long only and hedge funds by beta. So for example, Will Ford oversees our marketable equity team. So that's everything that's publicly traded, as well as hedge fund strategies, equity long short. That team is all organized according to whether they focus on equities. And Delari Pancholi oversees our credit and multi-asset teams across both long only and hedge fund strategies. On the private market side, we have Josh Beers, who oversees our private equity team. Oliver Fabley oversees private debt, and Matt Ritter oversees our real assets. So that's real estate and hard assets team. The left side of this page shows some of our other research teams within our NEPC broader group, and that includes our asset allocation team, portfolio construction, as well as research operations, operational due diligence, and outsourced CIO. And I'm really pleased to share that we have 3 new partners within investment manager research as of January of this year. So if you haven't already done so, please join me in congratulating Delari Pancholi, Matt Ritter, and Josh Beers, who are some of the newest additions to our partnership. All right, and here we drill a little deeper into those other teams within research at NEPC. And here, this is our investment manager research team. We have about 45 people dedicated to our manager research efforts. So with that, I am going to hand it over to Rosann Halleran to talk about our process.
Thanks, Sarah. Hi, everyone. Thanks for joining us today. I am going to walk you through the various steps of our manager research process. You'll see from this first slide here that it is a 5-step process. We begin with a screening of our ideas. Our researchers will get ideas from various sources, but the majority of our screening will begin with screening through an investment universe. We'll take the screening we conduct through an investment universe, and then we put it through a proprietary screening tool. That proprietary screening tool is mostly quantitative and just gives the researcher ideas of where they may want to focus their efforts further. After the researcher has determined some strategies and firms they'd like to drill down on a little bit further, they'll move to the next 2 steps, which are quantitative analysis and qualitative due diligence. I'm going to get into these steps a little bit more on the next page as I move through our investment framework. Our investment framework is something that all researchers use that gives them the ability to rate their strategies, rate the teams and strategies and firms on both quantitative analysis, and they'll also conduct some written analysis in these frameworks. After they have gone through all the various steps of the framework, they'll bring this to committee for the approval. For public market equities and fixed income, that'll be the Marketable Investment Committee. With this committee, they'll present their results, both the quantitative analysis and their written analysis, for approval of their overall due diligence rating. The overall due diligence ratings will then go through more monitoring. Strategies that are approved for 1 through 3 ratings are strategies that are considered acceptable for client use, and then we'll go to a regular due diligence process, which will include regular due diligence questionnaires. Those of you who have gone through this process will see the questionnaires come through us mostly through Diligence Vault. And we'll ask for things such as quarterly performance updates, firm and strategy updates. So now I'm going to move to the next slide and just go into a little bit more of what our framework looks like and what we're going to evaluate if we are looking more at one of your strategies. So you'll see that this slide contains both quantitative analysis and qualitative analysis. Our quantitative analysis really gives us a chance to dig more into performance of a strategy. Here, we don't just want to know if a strategy has outperformed or underperformed. We really want to dig into the market environment and see what's going on for that strategy. You'll see here things like second level thinking, luck versus skill, and likelihood of success. We're going to conduct factor attribution on the performance we're looking at. We want to know what the headwinds and tailwinds have been to the strategy we're looking at. And we want to know how the strategy would look, how alpha looks for that strategy if you were able to remove those headwinds and tailwinds. We're going to ask you for the strategy alpha expectations, and we're going to look at that over time to see how likely it is that this strategy can meet the alpha expectations. We're going to compare your performance. We're not just going to look at your performance on an absolute basis. We're going to look at absolute relative to a benchmark, and then compared to peers, again, most likely pulled from an investment universe. Moving on from the quantitative analysis, we'll look at our qualitative analysis. This is where we're thoroughly going to dig into the firm, the team, and the strategy. We're going to spend time asking questions about alignment of incentives. We're going to ask about business strategy and viability. We'd like to know if the firm is independently owned, is a subsidiary, or is a publicly traded firm. And then within that, we're going to ask about things like how the team works, if it's a subsidiary, how the team is working with the parent company. If it's independently owned, we want to know about what the ownership looks like. We want to know if there's any ownership concentration, and then how the firm is thinking about succession planning when those owners are thinking about retirement. We're going to do something similar when we look at the team. We want to know, again, about succession planning, especially if we do identify that there's a key person risk for the team. We're going to want to hear about the portfolio managers and analysts. We're going to know who the key decision makers are, and we're going to want to know how the team is incentivized and how analysts get ideas into the portfolio. We're going to spend time asking about any additional resources the team has available, such as a team conducting any quantitative analysis or investigative journalists that are available to the team. And then we're just going to really want to hear about the team culture and how the team works together. Then we're going to move into the philosophy, strategy, and process. Here, one of the things we're going to ask about is your investment edge. And we don't just want to hear about your investment edge as compared to your universe. We want to hear about your investment edge as compared to those strategies you have identified as your closest competitors within your universe. We're going to ask about how the team sources ideas. We're going to ask about how the team gets ideas approved to move in the portfolio. We're going to ask about how sell decisions are made. We're going to ask about any constraints and just see how those constraints have worked in the portfolio. We want to know, what the initial position size can be for a new company coming into the portfolio, what the maximum size will be, if there's any sector constraints or country constraints within the portfolio. We're also going to ask about that risk management process. Sarah mentioned that this is something that's becoming increasingly important to clients, just risk management in general. We want to know if the risk management is handled within the team itself, or if there's a separate and independent risk management team. And if there is a separate team, how it is that the strategy team is working with that risk management team and how they're kind of looking at risk management, what tools are being used. So the researcher will look at all of these various factors. And again, they have ability to rate the sub-factors, which will roll up into an overall rating for them. And I'm just going to look at this next slide. And this is just basically something you can look at as kind of a checklist. This is, those of you who have had strategies that have gone through our due diligence process will know these types of things we're going to be asking for. But it's just things that, as I mentioned, the due diligence questionnaires, you'll get different types of questionnaires: firm, strategy, there's ESG. We're going to ask you about we're going to let you know that we're going to dig into things like your ADV. We're going to ask you for, we may ask you for different types of things for your performance, such as different attribution from you. And then it just lets you know things like about meetings we're going to have. Meetings can be held virtually. They may be in person at NEPC offices, or we may come on site with you to review a strategy. So I'll just move on to the next slide. And this is our overall framework ratings. You can see here, there are the 4 categories I've mentioned previously that we're going to rate on, the moving from firm through performance. You'll also see above the firm and organization on the left-hand side that there's an area for the analyst opinion. This is for the researcher to truly, after they have evaluated this firm and strategy on all these other categories, to truly express their opinion and how they believe this overall strategy looks to them. And then all of these factors will roll up to that overall due diligence rating, which, as I mentioned, will be brought through the Marketable Investment Committee. And you'll see here on the right side that the overall due diligence ratings that can be recommended. And as I mentioned, anything that is 1 through 3 rated is available for use in client portfolios. Those 1 and 2 rated strategies are considered our focus placement list. And 4 and 5 rated strategies are strategies where we have identified some concerns and would recommend clients not invest. So again, I'd like to thank you for joining us today. And I'm going to turn this over to Nina Petkova, who's going to walk us through search activity.
Thank you so much, Rosann, and hello, everyone. Nina Petkova, Senior Investment Director, part of NEPC's Marketable Equities team, and I specifically oversee our global equity long-only space, and so I'm sure I've interacted with a few of you on a regular basis. Thank you so much for joining us, and we really value our partnership and your time today, and realize that the more we can share, the better partners we can be. And one of the key pieces of information and feedback that we at NEPC and also any consultant can share with the investment manager community is a summary of our search activity. As an investment advisor that works with over 400 clients across a variety of segments, we sure have some valuable insight and data points to share. And so let's get right to it. What areas were most popular for searches and also reviews over a year like 2022? We all know what some of the dynamics that shaped our market environment in 2022 were. We started seeing a shift in regime that was very different from the one we have existed and invested in for the prior decades. We saw more volatility brought on by elevated interest rates and also stubborn inflation. Sadly, not much has changed now, almost 5 months into 2023. There's still a lot of going on and a lot of uncertainty in terms of our outlook for the economy. But on the slide here, we see total searches and reviews. And one of the first questions that I want to make sure and address is, how do we define a review? And I would say that a review is an analysis of the segment of the portfolio that sort of evaluates an existing mix of strategies and or also profiles alternative options. So on one side, you can think of it as a reflection of an annual revisit. And obviously some clients have that structure and others don't. And you can also assume it's very similar to a search, but sort of one step less formal. Across the board in 2022, we have conducted a total of 910 searches and reviews, placing or reviewing as much as 38 billion of our client assets under management. On a year-over-year basis, in addition to search activity driven by whether it's our asset allocation views and changing strategic and dynamic tilts, shifts in these numbers could also be influenced by 2 dynamics, and so I want to talk a little bit about that. One, it's any sizable clients being onboarded, and the second one being meaningful turnover as a result of manager with significant events. I will also say that every client situation is different, and when we review numbers in accumulation and aggregation, we can never fully rely on the data to give us a full and comprehensive representation, and as there may be many different dynamics. So take our numbers for what they are. And having said all that, we noticed that search activity in 2022 has been slightly lower across the marketable equities segment relative to prior years. Most searches and reviews were conducted in the non-US spaces, which is not surprising. We show the aggregate results for international EFI, including small cap, ACWI ex-US, including small cap, global and emerging markets, including small cap. Again, in all these spaces, we had as much as 70 searches and reviews. On the US side, we did have some sizable flows on the large cap side, and also saw consistent numbers across the small and mid cap space. We view large cap space as mostly efficient, so would typically advise for a passive implementation. However, early in the year, we advised our clients with passive S&P exposure to allocate a portion of that exposure to large cap value position, which could be reflected in some of the numbers. And one might say that was a timely call over a year like 2022. Overall, the number of searches in marketable equity space was muted relative to prior years, as I mentioned. And we have been active in advising our clients to be aware of this changing market regime, and also providing plenty of education on combating some of the investment biases that might present themselves, trying to advise away from buying highs and selling lows, and also awareness to recency bias and anchoring bias. On the flip side, we've seen on average more activity on the fixed income side relative to prior years. In 2021, we saw activity drop in half, and I would say again, risk assets back then were running hot. Fixed income was maybe not a priority for a lot of our clients. Now that has become an interesting space again because of where rates and spreads are, and I would say we expect that dynamic to continue in 2023 and on. If I focus on the alternative side, I would say that we're noticing some interesting activity as well. We've certainly seen activity increase last year and over the past few years that has been largely a function of clients in search of capture and return premium. As markets had robust returns in 2022 following that March dip, and also 2020, apologies, and in 2021 forward-looking expected returns for risky assets were muted. So we've seen the percent liquid allocations and targets to the segment increase over the last few years as clients have really been struggling to get to their budgeted returns. Sarah noted that we've seen a little bit of reset there. Additionally, we think that some of the numbers reflective of the alternative space could be a function of fundraising cyclicity. 2018, 2020, 2022 were commitment heavy years, for example. And we think that's maybe a little more of an observation on the private equity and private debt side and less so on the real asset and real estate side. And lastly, we've also become better at capturing search activity in this space related to the work we've done on demand forecasting side and also with our strategic pacing plan work. Okay, I want to stop here. I tried to extrapolate some of the major themes, definitely didn't cover all the dynamics there. And on this slide, we have included a summary of our historical search activity. For those of you who are joining this webinar for the first time, we always include this similar summary. But next, we wanted to focus onto the year ahead and highlight what our key initiatives are. I want to say that those have been very consistent over the past few years. You're really not hearing anything new from us. I'll quickly talk about the important topic of management fees, and then we'll pass it on to Lily to discuss initiatives on diversity, equity, and inclusion side, where we continue to push boundaries and progress on our commitment to identify and support diverse owned and led investment managers. So I want to discuss what NEPC's approach to the fee conversations is on behalf of our clients. As fiduciaries, it is our role to ensure sufficient excess outperformance net of fees. I'll talk to you about how we assess if fees are appropriately structured and also what you can expect from us. So on the next slide, this topic of fee negotiations is not new, and I'm really happy to say that because we have such great partnership with the investment management community, it's an easy topic to bring up and discuss, and so thank you for that. Our clients benefit from our large institutional asset base, which provides weight when approaching prospective investment managers and really helps us negotiate fee discounts, lower account minimums at the manager's discretion, and obtaining access to managers that are otherwise closed to new investors. We have lower fees on 460 investment fund vehicles. Majority of that is in marketable securities across both commingled funds and SMAs. We also have some on the hedge fund and private market side. One question that often comes up is, okay, how do you determine where a reduced fee structure is desired or needed, and how do you go about it? And so if we move to the next slide, I would say that our broad guidance is that fees should not represent more than 20 to 25% of the fund's outperformance over a passive benchmark. We look at that over a medium to long term, which means 3, 5, 7 years. We're proactively targeting high exposure investment firms and strategies, and also focusing on areas where performance doesn't justify the fees charged. And we also have a tool that we use. Additionally, this is a topic that is revisited with every focus placement list vetting and presented in our internal committees. And Rosann mentioned some of those committees. So I would say that it gets plenty of visibility across the organization. We would allow for sufficient time, as we often understand that this type of discussion goes through a fee committee or a group at your organization. And so we can definitely be patient and have some of those back and forth conversations. Before I pass it on to Lily to go through our DEI initiatives, I want to say once again, thank you all for the great partnership, and I hope that you find the information that we shared today useful.
Thanks, Nina. Hi, everyone. I'm Lily Fayerweather, an investment director on our public markets equity team. And today I want to spend a little time talking about what we're doing in terms of DEI. As Sarah mentioned, both ESG and DEI are increasingly important to our clients. So they're areas we're spending a lot of time on. And I specifically look at both of those areas. But since DEI is a little bit of a newer topic, and something that we haven't necessarily spent as much time with all of you on, that's where we wanted to focus today. If we look at the next page, we wanted to start by sharing some of our goals and our prior accomplishments as well. So we are, first of all, well on our way to accomplishing goals we set as part of our diverse manager policy, and you'll see more details about those goals on the left-hand side of the page. And there are two goals that we set primarily. In 2022, we set a goal to have 15% of the managers on our public markets FPL qualify as diverse owned and led by the end of 2024. And, you know, we recognize that while we can underwrite any number of managers, we're not making manager decisions for the majority of our clients. So investments with diverse owned and diverse led firms are really needed to be made to move the needle, regardless of, you know, what we underwrite. So because of this, we also set a target for our OCIO group, which does control manager selection. And that goal is to have a 15% exposure to diverse owned and led managers by the end of 2024. And I have mentioned the terms diverse owned and diverse led a couple times, so just want to set the stage here with what those are and how we define them. So a diverse owned manager, we are defining as one that has diverse equity ownership of more than 50%. And a diverse led manager would be one with diverse equity ownership of between 33 and 50%. So to that end, if there's a change in ownership at your firm that would impact whether the diverse owned or led threshold is met, please let us know so we can update our systems accordingly. Another accomplishment I wanted to mention has been the publication of our annual DEI progress report. Many of you likely saw our second annual report come out last year, and the first half of this year's report was actually released the other week. The second half is going to be coming out later this spring. We also held our fourth equitable manager participation workshop last spring, where we invited diverse owned and led managers to hear directly from our research team. And lastly, we launched the IDAC Summit this past September. We founded IDAC, which is the Investment Diversity Advisory Council, to bring together asset managers, allocators, and consultants to promote diversity across the investment industry. The organization has now successfully spun out on its own, and they'll be holding the next summit this coming September. Moving on to the next slide, wanted to share one big initiative that we've now officially launched, which is our DEI ratings. And these are going beyond equity ownership to really look at other aspects of DEI. And I'll share a bit more detail here on what we're looking at. So the assessment at a high level has two components, firm and strategy. At the firm level, we're looking at what sort of DEI commitments have been made, what diversity across the organization is at different levels. And we want to understand what sort of accountability exists to make sure commitments are upheld and that DEI efforts are really ingrained in the organization. We also want to know what resources are focused on DEI efforts. So maybe that's a focused individual or a group, maybe there are DEI focused programs in place, really anything like that. And we want to know who's involved in these efforts and what they're responsible for. We also want to know, what sort of DEI engagement is in place in numerous capacities. So is an organization working with diverse vendors? Or how is it interacting with portfolio companies on DEI issues? It might also be how a company is working with external organizations to promote DEI efforts. And then looking at the strategy, we want to understand what the diversity makeup of the team is and how DEI impacts the investment process from research to decision making. We're leveraging an RFI to gather all this information. That's something that some of you may have received, and if you did, thank you for completing it. And then we're compiling a comprehensive DEI firm and strategy review that we're sharing with our clients so that they really have a complete picture of what you're doing in terms of DEI beyond ownership. And just so you all know what to expect, we're completing DEI ratings for marketable securities strategies on our FPL first, with our goal to get to 100% completion by year end. And then we'll be moving on to other rated strategies and other asset classes. Moving on, we have also been doing a lot of work recently with the CFA Institute DEI Code Initiative. And the DEI code helps firms to demonstrate their commitment to improving DEI initiatives within their organizations and across the investment industry. We have been a signatory since April of last year, and in October, we reached out to all the firms that we had contact information for, which is about 2,100, to ask if they've become signatories, and if not, why. We really want to see our managers consider taking part in this initiative. And we had over 700 firms respond to us. And since our outreach, we saw the number of CFA DEI code signatories triple. So that really shows our ability to make an impact and to bring this important initiative to the attention of investors like you. So to that end, if you aren't a signatory, we really encourage you to consider it. Sarah is on the board of the CFA Society Boston, and she'll be the chair next year. So you can certainly expect to keep hearing from us on this initiative. Moving on, another way we've engaged with managers on DEI is through our Explorer program. Through the program, we identify high conviction managers that are diverse, owned, or led, and who aren't currently on our FPL. We put each identified manager through our full due diligence process, and those who are rated 3 or higher are included in the program and profiled in searches. So this allows us to bring more visibility to diverse, owned, or led managers that we may have previously overlooked because they didn't meet all the criteria for a 1 or 2 rated manager. That might be for a number of reasons, but some of the common ones are maybe that they have fewer assets, shorter track record, or higher fees. And then lastly, just wanted to wrap up with showing you what we've done so far this year and what you should be looking forward to on the next slide. So as I previously mentioned, the first half of our 2022 DEI progress report was just released, and you'll see the second half of the report come out later in the spring. We really believe that you can't manage what you don't measure, and that transparency is key. So we've endeavored to share in our reporting the type of information we'd ideally like to see from all of you. We encourage you to review our report and see if there might be an opportunity for you to start sharing your own reporting. We will also be holding our 5th annual Equitable Manager Participation Day in the fall. The event has been really successful in prior years, and it's a great way for us to engage with diverse, owned, and led managers. If you or anyone in your networks works for a diverse, owned, or led firm and would like to attend, please let us know and we can add you to the invitation list. And our diverse manager committee is also going to be working, continuing to work with our research team to expand the Explorer program to the alternative space and to identify additional opportunities for us to continue engaging with diverse, owned, and led managers. Then finally, we're going to be using the results of a DEI and impact survey we conducted with all of our consultants last year to guide our upcoming efforts. We got a number of really great data points from that, but a couple of key findings were that there's a really big demand for strategies that meet both impact and DEI criteria. So that's where we're going to be spending a lot of our time. And we also now have data points on which clients are interested in which topics. So that's going to allow us to more strategically target specific clients when we find appropriate investments. And that's hopefully going to allow us to put more capital to work efficiently. And with that, I'm going to turn it back to Sarah for some closing remarks.
Thank you, Lily. All right, so you heard from our team about some of the updates that we're seeing and trends that we're seeing in the marketplace. You heard about our team in place at NEPC, some of our priorities, about our investment approach, the importance of DEI. There's so much more we could cover, and we will in future calls. But I just wanted to close with a few final thoughts. One is that, you know, we really value our partnership with you. One way to keep in touch with NEPC is to stay apprised of our views on our website. We put a lot of information out there, which contains our views on the market, observations and studies on what's happening with all sorts of different client types. We really encourage you to bring forward your best ideas and focus on quality over quantity. A great way to do that is to ask questions and try to understand what it is that our clients are looking for, because we'll help you with that. We'll help guide you there and tell you all about the types of strategies and solutions that our clients need right now. Please be prepared to be open-minded to offering competitive pricing. As we talked about, we are very interested in you continuing to be a going concern and to be you know, a successful business, but our clients are very focused on fees, and so it is our obligation to bring that to you. And please be willing to take no for an answer. We believe in the value of a quick no. There are some resources. This is just a few examples of the types of things you might find on our website. Please visit it and now follow us on social media. And we can commit to each and every one of you that we will continue to provide this information on our client needs and search activity and on our views of the market and how we are evaluating managers. That framework that Rosann described is the framework that we use across each and every investment strategy type, from public markets to hedge funds to private markets. We will do our very best to be responsive to your emails and inquiries for meetings, and we will provide candid and transparent feedback in the spirit of really making sure that it's clear why a strategy may not make sense today, and if there are any things that need to be addressed or improved, we'll let you know what those are. I feel extremely strongly and I feel really good about the team that we have in place at NEPC and about the health of our business. Feel really good about the partnerships we have with each of you. And, I think it's important to just highlight the importance of all of our work as fiduciaries for these very big pools of assets that fund retirement benefits for hundreds of thousands, millions of people across the world. They fund research and innovation and healthcare. So this is important work that we're all doing together. And it is a pleasure to work with each and every one of you. So we look forward to continued work together and in collaboration in the future. And I know that you will be in touch with your NEPC contacts if you have any questions about today's call at all. Thanks very much, everyone.